Welcome, everyone. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Welcome to another episode of the What Matters podcast, the show that explores the fascinating world of wealth management and the trailblazers, experts, and visionaries who are changing the game of wealth management. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And alongside us today is Adam Jordan, a wealth of knowledge in the world of investments and compliance. Adam is a Director of Investments and Chief Compliance Officer of Paul Ried Financial Corporation. Welcome, Adam.
Thanks. Good to be here.
And thank you so much for taking the time with us today. I'm going to let Ashley get started here and delve into some important questions that we'd love to hear from you on. And
Yeah. So Adam, your extensive background in investments and wealth management is impressive. To kick things off, let's delve right into your journey and what led you to where you are today. So Adam, can you share the story of how you began your journey in wealth management and joined your firm back in 2002? You know, what sparked your interest in this path?
Yeah, it's been quite some time, so it's always surprising when people say it, and I'm like, that's been over 21 years now, kind of went before I joined here. So essentially, to caveat it, I was very kind of going into things, I was kind of skeptical of the traditional 4-year, college route of things. So I was naturally drawn more to kind of the technology field, somewhere where you can just kind of prove yourself a little bit more through doing and, kind of certification based. So I was in that realm of thinking. Obviously, though, in 2000, 2001, we're kind of in the depths of the .com bust. And obviously, kind of the tech field wasn't necessarily booming at the time. And so in that regard, knowing that I didn't want to go kind of the 4-year college route and skeptical of that, and that's maybe something that's a little bit more widely accepted now, as far as people realizing with the college debt and things like that. But as that kind of went through, I'm thinking what other, fields are a little bit more certification based. And finance is one of those. Obviously, you have, some routes, maybe like Goldman Sachs or something where they want to see maybe a bachelor's degree or something like that. For the most part, our field is more, you can have certifications to kind of prove where you're at. And also, I'll say this. So Paul Ried of Paul Ried Financial Group is actually also my dad. So different last names. Obviously, my last name is Jordan, and so technically he's my stepdad. Kind of came in my life during my elementary school years, but I consider him my dad. Obviously, it was kind of a little bit later on, and so I always call him Paul, just because the time that he kind of came in my life, but was truly a father figure to me. And Paul started the business actually back in 1987. So prior to that, he had been working at Boeing. He decided that he needed a change and decided to go into the financial profession. And when he was kind of starting the firm, since he had come from Boeing, he started out teaching classes at Boeing. So he taught financial classes at Boeing about how to invest in your 401k. And so obviously that's kind of how he built the firm. And it still to this day, we have probably 70% of our clients are Boeing related in some way. Probably a rough figure, but definitely a majority of our clients are still Boeing related in some way. But going back to me and what I was deciding to do, he had suggested at that time, I was studying for my Microsoft Certified Systems Engineer programs. I'm not even sure if that certification exists anymore, but at the time it did. I was doing that, and he was kind of suggesting, might you be interested in, the financial field? And I was definitely very hesitant to kind of go into something that my, father was a part of, kind of the family dynamics. And you always hear these stories and things like that. So I was kind of hesitant to do it. but decided to, it interests me. Finance always interests me, and it ties in so many different parts of the world. Whether you can focus on the economy, the investment side of things, that always kind of intrigued me. And being more analytical, it was more of the investment side that kind of interested me. And so, long story short, decided, okay, I'll take the plunge and join. But it was basically super. Paul's saying, you're starting on the ground floor. You're not getting any handouts here. You have to essentially join the firm, and essentially I was doing filing, and again, this was 21 years ago, so we're filing things in paper files everywhere. Order tickets that people were writing. I had to take those order tickets and log them by hand in the files. I'm sure not every firm was doing that at the time, but we were still doing it that way at the time. But I think it was really good. It kind of gave me a ground base, and kind of through the whole time I learned everything from the ground up, and that also kind of led to me knowing all parts of the business essentially. So because as I learned that, then I get my certification, get more into the investment side of things, and then kind of snowballed from there into my other roles as those led on.
So your stepdad that founded the firm, were you the only one of the of his kids that got involved in the practice, or did you have other siblings that got involved as well?
I was the only one that kind of went that route. My sister, she was kind of more involved in modeling at the time, and she actually does do some project based work here now. Just very recently, within the last 2 years, she kind of does some projects for us. And then my brother actually had passed away actually a couple of years before then. So it was kind of my senior year. He'd passed away from cancer. So he didn't go that route.
Yeah, I think on the with your stepdad owning being in this space, you had it a lot better than I did. My dad owned gas stations. And better yet, he owned ones that were across the street from one another. So my twin brother and I, he wouldn't let us work together because obviously we'd horse around. So we had to work across the street from one another. So anyhow, going into the next question there, in getting involved with the business, starting in wealth management in 21 years ago, you've likely seen some significant changes, obviously. 21 years ago, we're in, what was that, 2002? And then, there was a pretty big shock, black swan event that happened right in there in 2008. Can you discuss the evolution of, your role over the years and how it shaped your approach in developing and monitoring client portfolios?
Yeah, definitely been a lot of changes since then. Actually, it was really, when I started in 2002, and a lot of the industry was still, A and C share based. So it was all very commissionable. It was, there was advisory, but it wasn't very prevalent at the time. So at that time, it was a lot of A and C share business. Obviously, Paul always took the route that it was, planning first base. So now we're all, now everyone's used to the fiduciary standard and things like that. But, he really worked under that concept the whole time, even though it was using A and C shares. That was just kind of the tools of the day. But the first transition was, the transition to advisory. And that happened kind of early on, more around real push around, a couple of years after I was in, we really started pushing to move the advisory route. And that's kind of when I was taking over, looking in more on the investment, taking in more investment responsibility. I was really thinking about, how can we, if we're saying we're doing this for clients, how can we do it best? And if we're kind of locked in these fund families based on, C shares or A shares, how can we offer broader opportunity set to our clients, the full landscape of investments. So the first push was getting everyone to advisory, everyone that had been kind of on, C shares or things like that, transitioned over to advisory. So that was the first evolution was that route. And by 2006, 7, most people were getting, we had them in the more advisory, fee-based arrangements.
Now, can we back up just a second there? Because I'm sure our audience would like to hear. I know it might be a little bit of a rhetorical question for both Ashley and I, but can you give your definition of, wealth management and financial advisor? That often seems to be a question lots of people like to hear the answer to. And, they seem to, we seem to get different answers from different individuals, but I'd love to hear what you're about to tell us.
Yeah, probably makes sense to get different answers, because I guess everyone does define them differently, I guess, based on their way. But I would say, financial advisory practice, I would say it's leading first with the financial planning side of things. And so I do think there are two types of firms in our business. One that lead with financial planning, and then the investments are your tool to get there, to get through the plan. And then the other side is, they're going to lead with investments and say, why their, methodology is better than the next. And they're going to essentially, live or die, I think, kind of based on the performance. So I would say wealth management is more investment first, and financial planning is more, planning based. But again, many wealth management firms, and sometimes, people may, we may use the term wealth management, but so that's why I think there's a confusion, because people do use them interchangeably, but I do think they have two different kind of connotations.
And let me ask you this, now that I we get our information, it always seems to be different when we talk to our guests, that you guys have crossed over, managing $1 billion in AUM. And how's your structure set up there? Do you guys, have, in-house advisors that work with you guys? Have you guys grown the company organically or inorganically?
Yeah, so everything's been organic. So it's all been referral based pretty much since I started, and well before then as well. So it's all referral based. And our structure is, Paul, started the firm on his own and brought on his first advisor in the early 90s. And then, so through the 90s, it was, pretty small team. And as I came on, it was around the time he was also adding some more advisors. But I think the key is, every advisor is not kind of doing their own thing from the start. Paul wanted to make sure that it's a cohesive unit, and a client, whether he talks to this advisor or another advisor, they're getting the same message, and they can answer their questions as well. So it's not
really cool.
So we don't want the client to think this is my advisor or this is my advisor. I mean, they do have a primary advisor that they'll work with, but if they call and that one's not there, it should feel like the team. We're all working for the same goals, and we're all focused on the whole client base. But we do segregate, responsibilities as far as we have the advisors, and then we have the investment side of things and the operations side. So we kind of have our departments, but we're all working for all the clients all the time. We don't have necessarily different teams that work with one set of clients and another team that works with another set of clients. So
real cool.
And
go for it, Ashley.
How many advisors do you guys have now?
Yeah, so we currently have 4 advisors. We just brought on, actually just this week, a 5th advisor. So he's not currently meeting with clients yet, but so we have 4 advisors that are kind of meeting with clients full time, and then we just brought on a 5th. So we have about 12 people total in the office right now.
I like that. So with that being said, when, obviously going through, some challenges and growing the organization, we saw the first black swan event. I think we'll call it in 2008. And there was a couple little hiccups, one in 2016, I believe Brexit was 2018. Then COVID in 2020, and then 2022. It seems like every 2 years there, right?
Yeah,
right.
Unfortunately, no.
And then in 2022, the market got bludgeoned, right? So, if you don't mind me asking, there, how'd you guys overcome that? And what did you guys do to maintain the growth of your organization?
Yeah, I think yes, it was interesting. Kind of as I was taking over responsibilities, kind of on the portfolio management side of things. Kind of the '08 crisis was definitely very interesting, but I think it also helped kind of move me along in my career path. And I think after the '08 period, I think they were comfortable giving me a little bit more control over the investments going forward. So that helped me, while it'd be more responsibilities a little bit more spread out on the investment side going into it, kind of coming out, kind of my role kind of got elevated a little bit through '08. Obviously rough time and not something you had seen through that point in time. But I think a key aspect of how we keep growing is the fact that we always lead with the plan. We always keep the client's mind on the plan. And are we still on track to whether we've gone through '08 or whether we've gone through, the COVID period, everything we've gone through, let's go back to the plan. When you came on, are we still on target for that? Now, it might be harder for clients that just onboarded and then they go through something because they don't have, they have such a short time period to look at. Yeah, you might be slightly below where that plan was predicting at the time, but we said from the start, there's going to be the short-term volatility. So it's the longer that clients are with the firm, the more that you can always bring them back to the plan and say, we've gone through this. This has been a tough period, but see, we actually are still on track for your goals, and you're going to get where you need to be. So even when client or advisors meet with the clients, they don't actually talk about the investments until maybe the third meeting. Usually we'll have a few meetings before they become clients, and it's generally not till maybe the third and onboarding meeting or something like that they're actually talking about the investments themselves. Everything else is planning focused and that sort. I think that really grounds them a little bit.
Yeah, I think it goes to the old saying of, just because you know how to make money doesn't mean you know how to invest it. I always say to people, they go, what are some good stocks to invest in? I go, well, I'll guarantee this. Anything I put money into, just short. Right.
Yeah. Gonna make ETF out of that.
Right. Just right. If I buy it going long, you short it. If I get calls, you get pushed. Just do the opposite of what I do.
Yeah. So you speak a lot about clients. What inspires you the most about working with your clients, Adam?
I think it's mainly just watching kind of that journey I was talking about, watching them, get to where they need to be. And again, I'm not generally the one that's the front face to them. I'm kind of doing the investment side of things. Where I come in is if they have deep questions on the portfolio, something out, they want to dig a little bit deeper into the plan. Then the advisor will bring me in so we can kind of discuss the intricacies of what the funds are doing, how they're doing it. So really the investments really interest me, but it's also how you build a portfolio that's not the best theoretical portfolio, but it's the best portfolio that a client is going to stick with. And there are a lot of things you can do, ways you can structure portfolios that may trigger some bad, just the innate negatives of psychology. Like if you have too many sector funds or something like that, in my mind, if you have too many these volatile line items of sector funds or individual stock positions that may be, extra volatile, I think those are, while they may get you where you want to do on the actual portfolio side, it might trigger some bad emotional responses in clients and make them abandon the plan and freak them out. They see something going down here, they want to sell it at the wrong time. So kind of structuring portfolios in ways that clients are going to stick with them is important.
Depending on what their risk tolerance is.
Yeah, exactly. Yeah, and it's not, it goes beyond just putting them in the right, portfolio volatility level. It's more so also, you could have two moderate portfolios, but if one has all these pieces, that are extra volatile, even though the portfolio is not volatile, if they're seeing these line items that look volatile, that can, trigger them to, deviate from the plan as well.
Yeah. Is there a specific client experience that you've perhaps had that you could share with us where you felt like you made a significant impact? And maybe it was very special for you or for another advisor within your firm that you could share with us?
Oh yeah, that's a tough one. To me, I don't know. I can't think of the client specifically, but I can think about the situations where it was. And it really is those situations where you are able to talk them off the ledge. It's those 2008 periods when, it's, December, 2002 or March 2009. I mean, March 2009 is a better one. March 2009, they're ready to throw in the towel. They understand, they don't see the point. They know everything's just going to blow up. It's the worst. But talking them through how, history has been, how even though this is the unique period and we've never seen anything like it, stocks and bonds both kind of going down. We just saw that again this last year.
Yeah.
but even last year was a little bit more interesting just because you had high quality bonds going down and stocks going down. When 2009, it was more, treasuries did all right, but lower quality bonds and stocks were ones going down more so there. But it's during those periods, whether it's, last year, COVID, 2008, in the depths of those periods, talking them out of making the wrong decision and then seeing how that pays off through time. Those are kind of the things that I think are impactful, keeping them onto their plan.
I really like what you said there because, I don't think anybody ever pats you on the back when you guys do a good job, right? You have years where, they might make 25, 35% in 2020, 2021. And, I'm sure you get very few thank you letters or, gift baskets sent to the office. But in a year like 2022 that happens, right? Or, you're getting bombarded with scathing emails and phone calls and, why didn't you tell me this? Or, they don't take in consideration that, still at the end of the day, they're still going to be up 15 or 20% over the 2 or 3 year period as projected. Right. So I like what you said, right? Because, the kudos doesn't necessarily need to come from them over time. You show them that, like what Warren Buffett says, the stock market rewards the patient by taking the money from the impatient, right?
Yeah, exactly.
So, I like that. And did anybody come back to you and say, when their portfolio was probably down 50, 60% in that 2009. And then, they're like, well, I'm going to lose 100%, right? The world's going under, and you talked them off a ledge, and that was probably, it might've gone down a little bit more. And then, it had a massive rebound after that for the next decade.
Yeah, exactly.
So let me ask you this, obviously with where the market's at right now, and, before we get into, what you think might occur in the upcoming years with the way interest rates are and, where the 10-year treasury is and, the other treasuries as well. But, what's, in the deck of cards for you guys? What are your guys' plans on the horizon?
In regards to the business, business wise, well, I think it's continuing to do what we've done, and continue to provide the services to our clients that we say we're going to do. So it's not necessarily, and again, kind of just take a step back. We went, it's been a transition through time. I said, the ANC shares to the advisory in the early 2000s. And then it was finally realizing, and I think it was 5 years ago now, so 2018, because we were mainly doing, our advisory business was through a broker dealer at the time, so their RA side of things. It was that time when we realized we need to make a transition. We needed more flex to give our clients what we think is best. We were under some constraints, and whether that be technology or on the investment side, and so we made the jump to our own RIA in 2018. So that's kind of been a progression. We think really that did give us the tools for the long run here, where we're in control of our own technology, that we're giving clients the way you display information. We're in control of. So just continuing on this route. No big changes. We're not looking to merge or anything like that. Just continue our independence and serving our clients.
Real cool.
Yeah, I like that. So, looking forward at the future of wealth management, not just for your firm, but particularly in terms of emerging trends, technologies, strategies, what do you think will influence your role and your firm's approach to serving clients in the future?
Yeah, I think probably two parts of that: the industry and kind of the investment side of things. I think on the investment side of things, the biggest changes I think over the next 5 years will kind of be more focused in the kind of the non-private markets a little bit more. I know they're coming out with a lot of structures to try and bring the private markets to more accessible levels. And so I think like interval funds, for instance, I think there will be a lot of growth in the interval fund space. I think there's still some fee issues there, and I think there still can be some more growth in the type of products that are made in those structures. Like a lot of them right now are, you're doing private credit, or you're doing private equity, or there's timberland or infrastructure here, and they're all kind of segregated, and you almost have to build a whole portfolio of each one of those. I think in the interval structure, I think they could, I think more of a multi-asset class approach to the interval structure would be a little bit more ideal. I think that would also solve some of the liquidity problems. If you just have one asset class in the interval fund, then if that asset class is doing poorly, then the fund is going to have a lot of withdrawals. And obviously that's when you can have lockup periods on that. Whereas if you have a multi-asset class approach to it, then the manager can draw from the area that's not under pressure to help alleviate some of that liquidity concerns there. So I think one big thing is going to be kind of the growth of kind of the middle market. So not totally mutual funds, ETFs, but not totally private. So it's kind of bridging that gap through interval funds. So that's on one trend I see on the investment side. That's definitely I see growing. And on this industry side, and everyone talks about it, but it's the kind of the consolidation, the big firms. I think one thing that I find interesting is you have so many people started their RIAs because they didn't want, a behemoth that's kind of trying to serve to every advisor's needs, and so they have to put these sort of compliance constraints that aren't SEC requirements, but they're requirements that they're putting in place because they don't know exactly what all their advisors are doing.
Sure.
So they have to put these broad-ranging policies in place that really constrain the advisors. And so whether people left the wirehouses or they left the broker-dealer world because of these, they went to start their RIAs, but then they're either jumping into, they're either going into these kind of conglomerate aggregator sort of RIAs, which really is, those aggregators in my mind are, some of them, and they all have their different approaches, but a lot of them are just replicating the broker-dealer model for the RIA world. And so you're really just in the same place you were before. So I think if you are joining a bigger firm, understanding, what flexible are you under their RIA, or are you under your own actual RIA? Those sorts of differences matter, because it also matters how they're going to structure their compliance programs and those sorts of things.
So, obviously with the world of artificial intelligence coming into play, and given your extensive experience and expertise, especially in the tech space, what are your insights in the near and long-term, economic outlook? I brought up earlier that, we've had just a really insane spike in interest rates. I know you want to get a home mortgage right now. I was looking, and it's like 8.5%. And that's just insane, to keep in mind that it was, 2.75% just a couple years back. Right. I'm sure there'll be some sort of equilibrium in the middle that will, bring it back down to 5 or 5.5 at some point. I don't think it's going to be anywhere in the near future. What are your thoughts on everything that's going on there? What do you think is going to take place in the equities market, in the bond market? What do you think?
So I think, as far as the real estate market, this is a real interesting one to me, because you have, nationally prices haven't moved all that much. There's pockets here, we're maybe down 15% or so. I'm not sure Arizona's maybe down similarly. San Francisco, down about 15% or so. But if you look at what we're still up from pre-COVID levels, I believe our area is still up about 30% from pre-COVID. I'm not sure about, I think Arizona's probably up maybe even more than that since pre-COVID times still. But yet pre-COVID, we were in a low interest rate environment. And today we are, and back to, 20-year highs in the mortgage rates. So it's a very big disconnect. I understand the limited supply that we're all talking about. But one thing I'd like to bring up, there's also a limited supply of price insensitive buyers. Interest rates increased very dramatically in a very short period of time. And so, maybe, and people don't want to, people haven't wanted to move because they have those sub 3% mortgages.
Right.
So they're not putting their house on the market.
They'll tough that one out.
Exactly. So they're not trying to move. So there is limited supply, but still there's, I think over this year of rising interest rates, the sales have been going to the people that are kind of price insensitive. They're maybe the ones that saved up a lot during the COVID time period. They kind of had this nest egg that they were able to build up from not going on vacations and not doing these other things. But I think those people have dwindled down. They've already bought now. So now we're a year into it. But now we're even at higher mortgage rates, 8%. Who's going to be the new buyers going forward? So I do think the next 12 months is going to be real telling for the market. And I do think it's going to come under true price pressure, especially even on the national level. I know we've had a few cities here or there that have come down a little bit, but even here, even I own a house, I don't want to see its value go down, but all the other houses will be going down alongside of it as well. So it won't be that big of an effect, I guess.
Well, and you even have to ask yourself if the trade-off is even worth it, right? Because I know that I sold a lot of my residential over probably up until about a year and a half ago. I got rid of it between late 2021 to mid 2022, around that 7 or 8 month period. I got rid of a lot of residential I own, and I can tell you that in Arizona, keep in mind, it's kind of like a penny stock, right? Up where you're at in Washington, right? There's a lot of there's a lot of businesses that fuel the economy, and here, due to weather and the lack of I should call it schools, right? That you have here. You really only have what is it, under 200 total colleges and trade schools here, or I'm sorry, I believe it was 21 or 22, whereas California has over 200, right, colleges out there. And so, we don't have tech here. There's no manufacturing and, and no agriculture. And I think with that being said, when property values go down here, we see it a lot worse. I would say, for the higher end homes, I've seen, some of these $10 million homes go for 6.5, right? We're already seeing that, seeing like a lot of the $3 million homes starting to go for 2.1, 2.2, depending on, how desperate the seller is. But yeah, we're seeing a lot more of that here than I think in other places, where, but I do think I can speak personally in getting rid of my real estate, right? I might have cashed out and made that extra, 20%, but I can't go rebuy. Right. So therefore, I blew my 1031 exchange, right? Because I was like, at that time, I was like, I don't want to buy it. Your rates are at 6. They got to go down from here. Yeah, I would have no clue that, I said, yeah, maybe we'll wait for them to go down a little, right? I got a little bit of time, but man, this is, I do think when the 10-year hits around 5.25, I was in the mortgage business for 27 years prior to private equity. So, I do think that there'll be some, there'll be some sort of, interest rate drop at that point. I don't have a crystal ball, but I think it's insane to see what's going on now. What do you think about? Tell me this. What do you think is going to happen with a lot of the other debt that's going on? Obviously people have to trade in their cars. Car interest rates are at 12% right now. 13%. I mean, they're going up to 45% depending on what your credit is. But if you have darn good credit, your interest rate, if you go and buy a car right now, is at least 9.5%, right? And then you got credit card debt that's resetting and whatnot. Do you think at some point there's a lot of equity that's still sitting in these homes, right? I mean, home equity line of credits are really tough to take out if you can even qualify for one. Do you think at some point, in your opinion, that people will start refinancing to get this equity out to, subsidize that higher interest debt that's going on? Or do you think that those 2.5, 2.75% interest rates were just, they ain't going to touch them? Right.
Yeah. I think one is I wouldn't see people tapping their home equity too much, just because even the rates aren't that, isn't it? I mean, you're getting, home equity loans are 8.5%, 9% now. So, all the other rates are, your car rate's a little bit higher, but the spread isn't that much different. So that's what I think the tough part for the economy is you're not going to have, there could be two takes on people staying in their current homes because they have low rates. Some will say, well, this is going to be great for, home renovations because they want to move to a bigger place, but instead they're going to keep their, current mortgage and expand. But is that going to be feasible for them? Because most people did that with home equity loans before, and those home equity loans were, half the rate that these home equity loans are now to access your home equity. So yeah, it's equity, but you're borrowing against that equity, and so that's an expensive proposition. So I think the economy just kind of, even for car sales going forward, it's going to put pressure on people buying new cars. So the economic, that's why the Fed's risen rates so fast that the economy hasn't been able to adjust to this, and so we haven't really seen the effects of the slowdown that the previous hikes even caused, because it takes time for these things to kind of flow through the economy. So I think there's a lot to be said, and the further pressure kind of going on the broader landscape of the debt scenario here is over the next year. I believe I saw the figure, I think Apollo put out the figure, it was 1/3 of all U.S. treasuries actually are getting rolled over next year. So come due, which means they're going to then, reset at higher rates. So not only are people, mortgages, maybe if they move, get reset to a higher rate, the government itself is going to be paying a higher interest. These are coupons that were probably, 1% to 2%. The government issued those, in the last decade there. So that's going to now reset, and the government's going to be paying 4 to 5% on that. I believe, now the 10 years up to about 5 itself. So they're going to be paying 5% on all this new debt. So the new interest costs are definitely for the government going to be drastically increasing. So I think the next 12 months will be interesting, because I think also the political dynamic that this is going to cause is the government sees their interest costs go up, and the government's never at fault for this. They don't say that they're spending or anything like that's the reason for this. What they're going to do is say, well, it's the Fed's fault. They raised rates too high. Now our interest expense is too high. So I see them probably going to put pressure on the Fed to lower rates, but that's going to be a dynamic. The Fed never wants to give in to political pressure, so it's going to be a little fight there. But so that's going to be pressure to lower interest rates sooner. But with the inflation scenario the way it is, I don't see the reason to lower rates other than kind of a political reason. And just to backtrack one more step to housing, I would also say just one dangerous piece of advice that I think maybe every realtor gives their clients out there is that you buy the home, date the rate, or something like that. So, but you don't want to, you can't buy a home. You don't buy a home if you think you only have to put up with these higher rates for a short period of time, and then they think, I can just refinance in a year or two. But you're forgetting the fact that rates can also go down and house prices go down.
Right. And then they got no equity and they can't refinance.
You can't refinance. Exactly. So I think that's a very dangerous proposition. If you're buying a home, you need to make sure that you can endure that rate through time, and it doesn't, mess with your budget in drastic ways.
Yeah. But, if you even think about, like where you live, right? $1 million home is I don't know if that's the average price, but
pretty close in Bellevue,
right? So let's take in consideration you buy something for $1.25 million, right? You put 250 down, finance $1 million. In 2021, your mortgage payment was like, if it was just an interest only payment, call it, right, you're talking about $2,100, right? Yeah. And so let's just hypothetically say now you got that same house for $1 million, right, instead of $1.25 million. You had 700, you financed 750,000. You're looking at that same payment on 25% less money. You're paying, gosh, what is that? Oh, that's around $6,500, $6,300 a month, right? If you were to get an 8.5% rate, that'd be about 5,200 a month. That'd be, more than double what you're paying in interest than what's going on in today's market. So, I think what I can tell you is, having been in the industry, when the subprime mortgage industry was melting down, I liked what you said earlier about it takes time for people to actually realize and understand. We started seeing blood in the water probably mid 2006, right? Yeah. It was, and probably by the beginning of 2007, first quarter of 2007, they're like, we're not buying that crap from you guys. Yeah, the loans that we didn't want to bank in house, we broker them out, and they go, no, we're not going to buy these from you guys anymore. That was by the beginning of 2007, and then so about a year and a half before the market really came, knew about it, we were feeling the pressure, so I think with that being said, do you feel any of that pressure going on in the RIA space? I mean, do you feel, I know the stock market moves a heck of a lot quicker than the treasuries do, but do you see, anything potentially happening with, having some, two different wars going on right now, high interest rates, more debt than we've ever seen before? Do you see a black swan event coming on, or? And if you don't feel comfortable giving your answer, I totally understand.
No, there's always, I guess, black swan possibilities, and generally when I kind of see wars pop up or those sorts of things, one thing I would kind of point out too, though, is it's all about what are the ripple effects, not necessarily that particular event itself, and it has to become something that actually affects companies. And you know, unfortunately, while we like to look at wars and assume it's a bad thing for markets, reality is you have to look at whose earnings are actually getting hurt by wars. Unfortunately, not many companies' earnings actually get hurt by war. I mean, it's fortunate that it doesn't, but it's kind of, in a humanitarian way, it's not so good way to look at it. But no company's earnings are really being negatively affected by most conflicts. Like, think about even whether it's Ukraine or what's going on now kind of in the Middle East. It's Microsoft's not going to make less money because of these conflicts. But what does happen, what does scare me, or would worry me more about Black Swan, is when you get to when things escalate and it truly becomes a bigger players involved. So the whole China thing would be, even though it's probably a very, very low risk scenario, you have to think about investing there. How do you analyze a company's worth if at some point, think about the Russia scenario, when we could no longer trade in Russian securities. Those Russian companies still exist. They still make money. Someone that owns their stock that is in Saudi Arabia is still getting dividends from those companies, but here in America, they're all marked to zero. And so you really have, that sort of risk when you're thinking about China or something like that. It's on a much bigger scale and much bigger ramifications to get that extreme. But those are the sorts of, in all the, obviously all the, tech, interplay that comes into that. And that's when you do get companies' earnings getting affected. And you already are with the chip makers and things like that. When the governments start having to intervene or feel like they have to intervene, that's when you start actually hitting earnings and could have bigger ripple effects. So I'd say the biggest black swan would be something like that, no matter how minute the odds might be.
So let me ask you. So you're saying that if you own, because I bought a couple Russian stocks, it was the Russian Facebook. I bought it. I think before the war had broken out, right? And I was buying it for just a quick trade, next thing you know, I let it sit overnight and it's been marked as zero, like you said. So you're saying if I lived in China, I would that stock would not be marked as zero. It would.
Yeah, depend. Well, it depends. Yeah, exactly. So probably most people, I can't speak exactly because it has to kind of do with the piping, who you're brokering it through and things like that. So
Gotcha.
So it really does matter though about basically the government's take on how they're gonna deal with that. But yeah, there's Russian companies still, they're still ones that are making money still and things like that. But there's no way to trade them essentially.
Gotcha. Wow. Well, thank
Very
you.
interesting. Well, Adam, I hate to make us wrap up today. Your journey and insights into investments in the world of wealth management are truly enlightening. Thank you so much for joining us on the What Matters podcast today and sharing your wisdom with our audience. It was really intriguing to have you with us. I really appreciate it. And to our listeners, thank you for tuning in, and come back next week for more captivating discussions on wealth, investments, and the future. Thank you again, Adam.